Welcome everybody to another Directed IRA webinar. My name is Nate Hare. I'm joined by a new face to many of you, but not a new face to us. But this is Daniel Tercey, one of our senior IRA account executives. Daniel, tell them a little bit about yourself.
Hey everybody, Daniel Tercey. I've been with Directed IRA for a little over a year now. Been doing educations across the country, primarily for real estate investors. But it doesn't stop there. I help with private money lenders and all of the above for alternative assets. And I'm just really excited to be here.
So he's been training with myself, Matt, Aaron, and he's done a great job. He actually does some national speaking. He just moved here from Austin, Texas. So welcome to Phoenix.
Yeah, thank you. I got it when it wasn't so hot, so I'm pretty excited about that.
Right. So we love having him. You might see him more often on some of the programs. Great tool if you guys have questions as well. We've got his book a call link if you guys have anything. One of my most favorite topics to talk about, and it's seasonally orchestrated for us to talk about, which is the Roth conversion opportunity. Probably one of the most slept on and most powerful strategies to wealth building in all the game, right? So we're going to be talking about different scenarios where you might think about doing a Roth conversion. We'll talk about what's the cost, what are the considerations to doing a conversion, because there are some timelines you got to meet if you want to do a conversion, okay? If you want to do a conversion this year, you got to do it this year. If you want to pay the taxes in this calendar year, 2025, we got to do the conversion. We got to step on that because we got to get that converted by December 1st of this year. But if you want to wait and delay the tax a little bit and kick that can down till January 1st, gives you a lot more time to pay the conversion. But we're going to talk about all of that costs, consideration. I've even got some case studies. I got some two cool case studies. One of a client that did it right, did the conversion before he made the investment, and the investment was really good. And I have a real case study, and I got permission from the client on one that wishes they would have done a conversion. And oh no, faced a bunch of taxes that he didn't have to, but there is a silver lining to that story as well. So Nat, if you want to bring up the slides, we'll just jump right up into it. And again, this is going to be educational. As a reminder, I am not a CPA. Daniel's not a CPA. We're not tax advisors. I will say we've been in the game for many years. I've been in the game for 13 years. I understand conversions. I understand the strategies, especially from a self-directed IRA perspective. But we do not give tax advice. I do not calculate your taxes for you. We do not make the decision as to whether or not you should convert. That's between you, your CPA, or your financial advisors. But we are going to go through some information to make you feel dangerous with, where maybe you can make your own decisions based on what we go over today. But everything is for education purposes only. So we're going to cover a couple different things. First, I want to welcome everybody who's new to the program. We get 60 to 70% of our viewers are new. So we will cover just real brief basics. You know, what is a self-directed IRA? What does directed IRA do? And then we'll dive into the Roth conversion topic. And we're going to start real basic. We're going to talk about, you know, why are we talking about a Roth conversion? Well, when we're talking about a Roth conversion, what we're really talking about is whether or not we want a retirement account that's pre-tax, or do we want a retirement account that's post-tax? A lot of times this has to do with what type of investor you are and what type of legacy do you want to leave your kids or your grandkids. So we'll just kind of define the pre-tax accounts versus the post-tax accounts. Then we'll talk specifically about conversions. Okay, how does the conversion affect you as a tax-paying individual? What are the costs to a conversion? What are the considerations you should make before doing a conversion? Daniel will cover the powers of a Roth IRA, because that's really what we're talking about. Converting to a Roth IRA is the end goal here. He'll talk about why everybody makes the big fuss about a Roth IRA. What's the big deal about this Roth IRA? Daniel's going to go over that and talk about, you know, maybe some misconceptions some people have about having a Roth IRA. Some people think they make too much money to have a Roth IRA. And then we'll end with two case studies that'll kind of wrap your head around it and give you some conceptual viewpoints on it as well. So first, let's talk about a couple accounts that we want to identify when we're talking about Roth conversions. And this isn't all of them, but these are the ones that we have here at Directed IRA. We have got personal plans, which include your IRAs. IRAs include your traditional IRA and your Roth IRA. This is really the basics, the meat and potatoes of what we're talking about today, is whether or not we want to grow our assets, grow our retirement wealth inside of a traditional or pre-taxed IRA, Or would we much rather grow it in an after-tax Roth IRA? They are both personal plans, but the way that they're taxed are polar opposites. But when we talk about this conversion opportunity, we're not talking about just traditional IRAs. We're talking about really any pre-taxed retirement account you may have. That could be a SEP IRA. It could be even a simple IRA. It could be your pre-tax solo 401k. It could be your old employer 401k that's probably all pre-tax or majority pre-tax. It could be a 403b. It could be a 457 plan. It can be a TRS, a TSP, right? We have all these retirement plans available to us, and a lot of times it's through our employer or through our job. But the fact of the matter is, most of those employer-sponsored plans are pre-tax, meaning when we make a contribution to that plan, we get a tax deduction at the end of the year. And if our employers are matching in that plan, they also get a tax deduction. There's not really much you can do about the tax deduction they get on the matching, but a lot of people just by default, their knee-jerk reaction when they set up a 401k or a 403b is your benefits program says, hey, do you want a deduction on your contributions or not? Knee-jerk reaction is sure, deduction sounds great. But what you end up with is just a big bucket of pre-tax dollars. And there's some pros and cons to pre-tax dollars. But I would say, depending on what you're investing in, especially if you have the opportunity to invest in some of the alternative investments we see, real estate that cash flows and appreciates, oil and gas investments worth royalties, private lending with tax-free interest income. A lot of times these alternative investments makes the Roth conversion conversation a lot more appealing and a lot more important because you're investing in maybe something that you know or understand or can gauge a little bit better versus just having your investments in stocks where you don't know if it's going to go up or down based on the day or the year. So we're going to talk a little bit about converting, but converting from these types of plans. And here's what we're really deciding as a person who has a retirement plan is how do we want the retirement plan to grow? All retirement plans are tax exempt, meaning when you buy and sell a stock in a traditional IRA, your traditional IRA doesn't have to pay taxes on the gains. When you buy and sell the same stock in a Roth IRA, the Roth IRA doesn't have to pay taxes on the gains. The biggest difference is when you take distributions. Okay, that's when the tax hits you. When we're talking about a traditional IRA, a SEP IRA, your simple IRAs, your 401ks, your other employer-sponsored plans, you pay the tax when you take the distribution. Now, I was conditioned to think growing up that a tax delayed was a tax unpaid, right? And I think that's where a lot of CPAs tell you is let's get you as many tax deductions as you want in your working years or many tax deductions as you can get in your working years so that you defer the taxes on the distributions to your non-working years. I would say that math makes sense if your retirement plan never grows. If I throw $100,000 in a pre-tax account in exchange for a $100,000 deduction, that's cool, especially if my income bracket is, my marginal income tax rate is maybe 35%. I get to take a $100,000 deduction. I'm talking over many years. I'm not talking 1 year. But I get $100,000 in tax deductions at, let's say, a blended rate of 35%. Well, if my retirement account never grows and I take the same $100,000 out in retirement years and maybe my income's lower and I pay tax at a 15% rate, that maths. Yeah. But for me, growing up, I was always interested in real estate investments, and I always foresaw my real estate investments not staying at $100,000 but growing to, say, $1 million. So when you start looking at that, the math starts not mathing. Right? I don't know if that's proper English, but the math starts just not mathing to me because I always thought, well, does it really matter if I get a deduction of $100,000 in my pre-tax account at 35% and there's $100,000, but it goes to $1 million? I'm paying more taxes because I grew the account. It doesn't matter what my tax bracket is when I take it out. It's a bigger dollar amount. So this is the consideration that we want to make based on our investments is, do we want to pay the tax now while our IRAs are small, while our 401ks are small, and let them grow to larger amounts where when we take the distribution out of a Roth IRA, we don't pay taxes on the distribution, regardless of how big our Roth IRA is.
I was always confused when I was younger too, being told that exact same thing. And I was like, but when I get older, I still want to be making $200,000 a year. How is that's gonna still, my tax bracket's gonna be too high.
Right.
So what do I do then?
The other question is, who knows what tax bracket you're going to be in? If you're not retired for 20 years, do you even know what your tax bracket's going to be? Exactly. So there's a lot of wishful thinking involved there. But I would say, it depends. When people ask me if I'm on stage, they say, well, what's better, Nate, a traditional IRA or a Roth IRA? I say it depends. It really does. I'll give you an example. My stepmom, not a real estate investor, but she did very well for herself saving her way to retirement. Okay, she invests in stocks and bonds, and that's perfectly good with her. She's comfortable with those investments. Now, if you looked at her overall retirement wealth, the majority of her retirement wealth is the money she put in as contributions. And she tells her advisor every year, she goes, I don't care how much money you make sure you don't lose mine. That makes sense. She saved her way to retirement. So if the majority of the money she put in there is hers, then yes, the deduction makes sense over the tax-free growth. But for me, I know a lot of different strategies, and a lot of them I learned from self-directed IRA investors, and I'll just give you one. You can buy real estate with a retirement plan, with a self-directed retirement plan. Self-directed retirement plans can even leverage debt. So I can buy a rental property with, say, $50,000 in my retirement plan. I can have a bank finance the rest. I can put a renter in the property, and the renter helps me pay off the note. And then maybe 15 years down the road, the house is owned free and clear, but the house is worth $350,000. So if my $50,000 investment can turn into $350,000 through my knowledge as a real estate investor, do I want to pay taxes on 50 or do I want to pay taxes on 350? The answer is pretty easy. So if I have that sort of forward thinking, or if I have an investment that I can use leverage, which I think that's one of the coolest things with a self-directed IRA is the ability to use leverage, well, then my decisions change as to whether or not the Roth or the traditional is more important. And for me, I like the Roth IRA. I even do a lot of notes. I make private money loans out of my Roth IRA. I get double-digit returns secured by real estate, short-term notes that compound annually. If you guys know the effects of compounding interest has that hockey stick effect when it comes to growth. Again, that type of investment strategy, I don't want to pay taxes on compounding interest. I'd rather have compounding interest go to an account that will never be taxed, which is why I like the Roth IRA. So let's talk a little bit about the Roth IRA. I know a lot of people are familiar with it, but even some people that have it miss some important nuggets. So why don't you give us a breakdown, Daniel, on how this Roth IRA works and why it's so cool?
Yeah. So, and just to go back on what you were talking about as well, just really putting it simple, if you put $5,000 into an account and you pay tax on it, and then you grow it to $1 million, and you don't pay taxes on $995,000, who wins? You or the IRS?
You do.
Exactly. So it's a simple process if you're continuing to invest and grow your account. And besides that, you also can be doing, as you can see on the screen, contributions, right? You're putting in anywhere from $7,000 to $8,000, depending on your age, and those can actually be withdrawn at any age, completely tax-free.
And right now, we're just talking about having a Roth IRA and making contributions.
Yeah, and this is really important because I'm 36, so I'm pretty far off from being able to take out my distribution tax-free, penalty-free. So if I maybe need the $7,000 that I put in there to go do something else, but what if I grew it to $14,000 in that amount of time? I can still pull out that $7,000, right?
Correct.
So it's a pretty nice deal you can do when you're setting up early on as well. Your qualified distributions. So this is a few things. We have one example on there, but there are many other examples. Like, let's say you have some education expenses that maybe you need to pay. That's a qualified distribution that you can take out. There's some medical expenses you can actually pay off if it meets certain criteria. But the one we have up there is the most important one, and this is the one that really everybody talks about. And it's being the age 59 and a half and having the Roth established for 5 years. Okay, that's very important. So when you put in your contributions, you can take those out right away. Let's say you do a conversion, right? That's what we're going to be talking about. What do we have to do there?
Pay the tax.
Pay the tax, right? So you pay the tax to get it into the Roth from your traditional account, whether it be SEP, Solo K, or traditional IRA, right? Or that rollover from the 401k from your old employer. Okay? But then you have to let it sit for 5 years. Otherwise, if you take the distribution out on the conversion, you're going to be hit with a penalty. I believe it's about 10%. Correct?
10%.
Yeah.
Early withdrawal if you're under 59.5.
Yeah, so those are the only two stipulations, though. 59.5, 5 years aged. And once you have that, you are tax-free, penalty-free for the rest of your life, which takes you to the next point. This is how you preserve your wealth, okay? Traditional IRAs, I don't know how many of you have heard about RMDs, right? Those start at the age of 73. And we always like to joke, if anybody knows how old they're going to die, if they don't know, they can go to the IRS.gov website, and they're going to find out right there. They're going to tell them exactly how those distributions need to be taken out in a traditional IRA. In a Roth, you've already paid the taxes. So the IRS is like, well, we already got our cut. So there's no required minimum distributions on those. And this is a way to preserve your wealth. Let's say maybe you have a traditional on the side, you didn't convert it, and that's what you want to use for your retirement. And you want to save the Roth for your kids or your grandkids, or maybe you got great-grandkids.
Yeah.
You can now give them the inherited Roth, and they have at least 10 years of tax-free income to benefit them and to procure their wealth and their status moving forward.
And I think that's one of the biggest things, especially for people who are investing in alts. I have an example. I have a client that had 12 rental properties owned in a traditional IRA. Okay, she stacked some pretty good real estate assets. They were all rented. They were all appreciating every single year. Now, she had never converted. Okay, she had never converted. The income was coming in. She took the distributions of the rents, and she paid her income tax on it. But the account continued to grow. The rents continued to increase in her area, and the properties were still good in great areas. Now, what she ended up facing is she faced that RMD age. She actually went 5 years into RMD age and started realizing that the RMDs suck. Because here's what happens when you have a traditional pre-tax account. Mr. IRS says, hey, remember all those tax deductions you took? You owe us, pal. We're going to start forcing you to take distributions out of your traditional IRA. And if you don't take the required minimum distribution, we charge you a 50% tax penalty on the amount you don't distribute. So here was her problem. She got to a point, and again, back to what Daniel was saying is, if you don't know when you're going to die or you don't know what your RMDs are, just go to irs.gov. They know exactly when you're supposed to die because they calculate your RMDs on it.
Universal health sheet.
As you get older, your RMDs increase with age. So each year, her RMD became bigger. So she got to a point to where the first couple years, she was able to pay the RMD or take the RMD with the cash flow from the properties owned in the traditional IRA. At some point, that levels out. She got to a point where there wasn't enough cash flow to the traditional IRA to cover the RMD. So if you don't have enough cash in the traditional IRA to cover the RMD, and you don't have other traditional IRAs at other places to satisfy the RMD, what was she faced on doing? Selling some of the property that were in great areas that were rented that appreciated every single year. So what she ended up doing at that point is she ripped the Band-Aid off. She said, nope, I don't want to sell these properties because these properties are going to my kids. This is why I built this stash. I can live off the cash flow, but I want this wealth to go to my children. So what she decided to do is do a conversion of all 12 properties, and we'll talk about how you can convert assets. But long story short, she stopped the RMDs through the conversion, and when she ended up passing away several years later, her beneficiaries got 12 rental properties in an inherited Roth IRA that continue to grow tax-free for 10 more years, and they don't pay the taxes. Had she not converted it, she would have had to sell property so the kids would have got less, and when she died, they get a taxable traditional inherited IRA. They have to pay taxes on the distributions, and they were working in high tax brackets.
And depending on when she started taking her required minimum distributions, which I actually think she falls into this, they're subject to a 5-year rule or the rest of her life expectancy.
Right.
So they actually get it for less time as well.
Right.
So I actually see in the chat a couple of people asking
let's take
some questions.
Let's take some questions if you got some questions.
So and it's going right into what we're talking about. I transfer a Roth from a different company to directed IRA. Does the 5-year hold time restart? It does not.
Great question. So opening a new Roth IRA, moving a Roth IRA, transferring a Roth IRA has no subject to your existing Roth IRA. So your 5-year clock, and there's really 2 5-year clocks. We're going to get to the main one, what we talk about on the conversions. But the 5-year clock we already discussed is the date of your first contribution, the tax year of your first contribution. So let's say you don't have a Roth IRA, you decide to open one, you make a contribution today for 2025. Your 5-year clock starts January 1st, 2025. If you open 3 more Roths somewhere else or open another Roth 10 years later, it doesn't matter. Your start date for all your Roths on the 5-year clock was January 1st, 2025. Now, there's a different clock when you do conversions, and we're going to get to that in a second. But to answer your question, no, you do not reset a 5-year clock by opening or transferring an existing Roth.
And then we also had another question that we're about to get to right now, which is, but I make too much money. My CPA told me I can't contribute to a traditional.
God, if you have a CPA saying that, fire them immediately and tell them to open a tax book and last.
They need to refresh their
couple
their
decades.
CPA. So that is definitely incorrect. Okay, if you think you make too much money, you are in the category of a backdoor Roth. All right, and this is just an extra step. And this is the beautiful part: is if you're making too much money to contribute to a Roth, you're actually probably making too much money to write off the traditional as a deduction anyway.
Could be, yeah.
So you're actually doing non-deductible contributions. And if you're putting $7,000 into a traditional IRA that's non-deductible or post-tax, you can transfer that over, convert it over to a Roth IRA. And you're not going to pay any taxes on that. It just goes directly into the Roth. So the steps above are you make a $7,000 contribution, $1,000 if you're above the age of 50, and then you go right into a Roth. You open it up, you fill out the Roth conversion paperwork, and the conversion is not subject to the income limitations. You can see on the screen that if you make more than 150, filing single, you start to hit a phase-out plan that goes all the way up to about 160. Okay, and once you hit that, you can't contribute at all.
They just say you can't have one.
Yep. And for married people, you have 246 or 236 to 246. So what I always tell people is, who cares? If you think you make too much money, just do a backdoor Roth. You're doing non-deductible contributions, you're converting it over to a Roth, and you're not paying any taxes when it hits that Roth. So there's no income limitations ever when you want to set up a Roth.
And just to give some foundation, there used to be an income limit on conversions. Yeah. Most people don't realize this. So in 2010 and before, they also had income limitations on doing conversions. It was $100,000. So in 2010 and prior, if you made a 6-figure income, it was nearly impossible for you to have a Roth IRA. You were above the income limit to make a contribution, and there was no conversion opportunity. In 2010, they took off the income limit on conversions. Now, the reason they did this is they started it back in 2005, and it pushed through to 2010. And it was really, I mean, what was going on 2007, 2008? Okay, the IRS was hemorrhaging for money. The IRS is in the business to make money. You're not making money. You're not getting tax dollars when people are unemployed and losing their homes. So one of the things that they came up with to stimulate some tax dollars was they said, you know what, we're going to remove this income limit on Roth conversions in 2010. And they actually, back in 2010, said, if you do a conversion from your traditional to your Roth, we won't apply any income limits. We'll even let you pay the taxes over 2 years. We'll let you pay half of it in 2010 and half of it in 2011. Now they require you to pay it all in the single tax year. But the point is that income limit has still remained off. This is not a doomsday scenario, but each year when we get through election cycles, there's always politicians that want to argue to put the income limit back on.
We actually have a deadline coming up in 2026 from the Secure Act for a lot of things that the IRS is supposed to be passing.
The point I'm trying to make there is don't take for granted that this conversion opportunity is going to be around forever. They could very easily put that limit back on, because if you think about it in concept, the IRS is scared of what really savvy investors and 6-figure income earners will do with a Roth IRA. You guys ever hear of Peter Thiel? Okay, Peter Thiel has a $7 billion Roth IRA, and the IRS can't stand it. They don't like us to make tax-free dollars, right? And the opportunity for everybody to make tax-free dollars through this backdoor Roth opportunity has been there since 2010. don't think it's going to be there forever.
And there's one more thing you can do here as well to avoid the income limits, which is if you're self-employed, you can do a solo 401k, right?
Correct. There are no income limits on solo 401ks. So that one of the cool things is we talk a lot about the mega backdoor Roth. So mega backdoor Roths is the same concept, but you're doing it in larger amounts. And you're doing it if you're self-employed and you have the ability to have a solo 401k. And again, we have the solo 401k option here and the Roth IRA option here. So, a lot of our savvy investors are backdooring on both accounts. They're making a contribution to their traditional IRA, maxing that out, backdooring it to their Roth IRA, and then they're maxing out their 401k contributions and doing the same thing with the same intended goal that all of their investments are growing in an after-tax IRA, Roth IRA, or an after-tax Roth 401k to eliminate the RMDs and basically grow tax-free wealth. So here are some of here's basically the cost to it. So I get a lot of these questions like, how much does it cost? Does the conversion amount does the taxes come out of the conversion? Okay. Basically, you want to think of each conversion you do, okay, is going to be totaled on one 1099 at the end of the year. So we're in 2025 right now. Let's say that I did a conversion back in April and I did a conversion today. Okay, 50,000 in April, 50,000 today. Come January, my custodian is going to send me a 1099 for the total amount, $100,000. It's a 1099 to me personally, because remember, we're taking money from a pre-tax account and moving it to an after-tax account. What do we have to do that? Pay the taxes. There's no penalty to convert. We just have to pay the taxes. So how it affects you is it affects you as a taxpayer because that $100,000 is just treated like income to you. So obviously, if it's treated like income to you, well, there's some other considerations there. Is it a good year for you to have additional income? Okay. Is it a great year for you to have additional income? Maybe you're in between jobs. Maybe you're in a low income year. Maybe you just foresee that you're in a good income year and you're going to be in a great income year next year moving forward. Okay. These are some of the considerations as to when you might want to do a conversion. So just remember that each time you convert, whatever the amount of the conversions are through the calendar year, okay, you're going to have to pay income tax on that. And you're going to want to know, where's my marginal income tax? Where do I fall in the marginal income tax bracket? Now, keep in mind, if you know how our marginal income tax brackets work, right, it gets a little bit higher at different stages of the game. So you want to consult with your CPA if you're thinking about doing large conversions, because a large conversion may have enough income that it might bump you to a larger tax bracket that maybe you don't want to be in. So a lot of people do wait to the end of the year to kind of figure out, okay, this is the amount of money that I made this year. How much can I convert? How much additional income can I add on to that through a conversion where I'm not paying too much in taxes? So just keep that into consideration.
And I think you're kind of touching on it, but you're not outright addressing it. They don't have to do everything at once, right?
No.
Yeah.
No, you can chip away. We call it chunking, and we'll get to that. There's a strategy to chunking that I'll get to in a second.
Sorry, guys.
It's okay. It's okay. So that's why I want to make sure you can do multiple conversions. There's no limit on how many conversions you do in the year. They'll be all totaled on one 1099 once we get through December 31st. Okay. Now, obviously, lower income years are great opportunities, or if you have large tax offsets, okay? Some investments give you some tax offsets, depending on the type of income that you're generating. You might be self-employed, running a business at a loss, okay? If you're showing a loss on paper, why would your financial advisor not be asking you how much money in pre-tax accounts do we have? If I got a $50,000 loss on my business, I can essentially convert almost $50,000 and be still at zero. So it's almost a free conversion. So that's more for you self-employed individuals. W-2 earners, we have it a little bit tougher, I know, but if you've got full-time real estate investor status, sometimes that gives you some tax offset. Some oil and gas or mineral rights investments gives you tax offset. There's a lot of different tax offsets that might play into the conversation of doing a conversion, whether it's this year or next year. And just remember, there's no penalty to convert. We're just paying the taxes. So there is some consideration and some strategy to how much is it going to cost you based on how much money you're looking to make that year. Okay. Now, here's the important 5-year clock rule when we talk about conversions. Now, we kind of talked a little bit about the 5-year clock rule when you make a first contribution to a Roth IRA. conversions have their own 5-year clock. And here's really the intended purpose of the 5-year clock on conversions. It's the way that the IRS eliminates or deters people from doing a conversion and just take everything out tax-free and penalty-free. Okay, so this 5-year clock, okay, is basically to prevent somebody from converting traditional funds to Roth funds and taking it out before 59 and a half with no penalty. Okay, so here's kind of how this 5-year clock works on conversions. First, each conversion you do through the year, they're all going to have the same start date, January 1st in the year in which you convert. So those 2 conversions that I mentioned, the start date of the 5-year clock on each of those conversions is January 1st of that same tax year. Now, the 5-year clock really has to do with whether or not that converted amount is penalized an early withdrawal penalty if I take it out. So let's say that I'm 37. I'm not, but let's just pretend I am, okay? So if I'm 37 years old and I do a conversion of $100,000, okay, I'm going to pay my taxes on the conversion, okay? Taxes are paid normally out of my pocket. They don't come out of the converted amount. That's really not the smart way to do it, at least. You can do it that way. But one of the things is you want to pay the taxes out of your pocket, just treat it as additional income to you. But if I did a conversion at the age of 37, okay, I have to wait 5 full tax years before I can take that $100,000 out with no early withdrawal penalty. It's basically almost treated like a contribution at that point. Okay, so I have to wait until 5 years. But let's say that I do that same conversion, but I'm 57. Okay, I'm 2 years away from being 59 and a half. I do a $100,000 conversion at 57. I pay the tax when I do the conversion. I can take the $100,000 out tax-free and penalty-free in 2 years. Okay, not 5. I don't have to wait 5. I just need to wait until I'm 59 and a half. So it's the whatever happens first, 5 years or 59 and a half, and then the 10% early withdrawal penalty goes away. When it comes to earnings on the converted amount, here's where the 5-year clock rules. It helps us on when we make our first contribution. You just need a Roth IRA open for 5 tax years so that the earnings are tax-free on a distribution as well. So best case scenario is we're doing a conversion, paying the tax on the converted amount out of pocket, and then we're not taking a distribution of anything until we've hit the age of 59 and a half and we've had a Roth for 5 years. And Roth distributions come out in a certain order. So you want to understand this too. The first money I take out of a Roth IRA come out of my contributions. Remember, I put those in after tax. Those come out tax-free and penalty-free whenever I decide to take them. But I'm always taking out of my contributions first. Okay. Next are your converted amount, the basis, the amount you converted. And just think about it. I paid the taxes on the conversion. Once the conversion's been in there 5 years, okay, assuming I'm not 59 and a half, those conversions get treated like basically contributions when I take the conversions out. And then earnings are the last things that come out, and we definitely want to make sure we have a Roth IRA open for 5 tax years before we start dipping into the earnings. So that's how the 5-year clock rule works on that. Do we have any questions that we want to field on 5-year clock rules or anything?
I haven't seen any 5-year clock rules, but I have one here that says, what are the IRS rules if an owner passes away during the conversion period of a qualified assets in multi-year scenario?
The conversion happens pretty instantaneously. Yeah, so I don't know that you would ever run into an instance. It would be a really short time frame. You'd have to you'd have to halfway fill a conversion form. I mean, if you fill out a conversion form to us, the conversion is being processed.
Like if they die as they're signing it.
Right, yeah. So I don't think that would be an issue.
And then the other one goes back to kind of what I brought up with the income limits. What if the income is above the limit and you max out your traditional IRA in a given year? Can you convert that amount to a Roth IRA in a subsequent year and still have it treated as post-tax contributions and not pay tax on the conversion? Which is yes, but did you take a deduction or did you not take a deduction? If you took a deduction, then you will have to pay taxes when you convert it into a Roth. If you did not take a deduction, you will not have to pay taxes when it gets converted to a Roth.
Right, because you're not going to be taxed twice. So it just depends on if you took the deduction, you pay the tax back. If you didn't take the deduction, there's no deduction you took, so it just moves over free of charge.
And then just to go into the 5-year rule thing, the way to really truly avoid the 5-year rule at all costs is just set one up for your kid now. They will not have to have to worry about this 5-year rule for the rest of their lives, and they can have one.
Right.
A minor child can have a Roth IRA, and you can get that set up as long as they have earned income.
Yeah, and the cool thing with that is that 5-year clock on earnings specifically, it starts January 1st of the tax year you make the contribution. So let's say you don't have a Roth IRA or you want to set one up for your kid. As long as you open a Roth IRA, make a contribution by next April 15th, the start date is January 1st, 2025. So that is cool. So just make sure you code that contribution for 2025, even if you make it into 2026, and you still get 16 months already into that 5-year clock. So, okay, so let's get into the nitty gritty here. Let's talk about some other considerations. So before any conversion, I think, what are your assumptions about tax rates and tax laws generally in the future? Do you think taxes are going to get more lax? Do you think taxes are going to go up? Do you think they're going to go down? Maybe in the interim, the short-term interim, are you expecting a job or a promotion that's going to, greatly increase your income, right? Where do you think personally for you taxes are going to be in the future, right? That's an easy one. Can you afford to pay the taxes from funds outside of your IRA? I think this is an important one. This is sometimes the one that's hard to stomach for people. See, if I convert $100,000 and I take, let's say, I don't have the money to pay the taxes. Let's just make a round number. It's $30,000. If I don't have $30,000 in my back pocket to pay the taxes on a $100,000 conversion, I could tell my custodian, well, just take the taxes out of the conversion. Withhold taxes for me. Well, in a sense, what we're doing is we're going to withhold, let's say it's 20% in taxes, okay? So we're not moving $100,000 from the traditional to the Roth. We're moving $80,000 from the traditional to the Roth. So you give your Roth less capital to invest. Where's the other $20,000 go? To Mr. IRS for tax withholding. But it's treated as a early withdrawal if you're under 59.5. So it's not only that you lose it toward the taxes, but you also have to pay a 10% penalty on the $20,000, which is a $2,000 penalty just on top of the taxes that you have to pay. Now, have I seen clients do that and be successful? Sure I have, right? If the investment's really good and that was their only opportunity to pay the taxes through the conversion, then by all means, do it through the conversion. But if you have the opportunity to pay it outside of the conversion, by all means, pay it outside of the conversion. The maths when you just pay it from outside funds and leave the Roth IRA with more capital that it can compound itself tax-free, and you don't have to deal with the tax penalty on an early withdrawal. Okay. Now, here's where it gets to the self-directed conversation, and this is where I've really seen investors take this to the next level because of the assets that we're looking at, right? Before you do any conversion, what I really think is the most pertinent thing to look at, what are you going to invest in? Don't convert just to pay taxes and just leave it there. But what's the end investment going to be inside of the Roth IRA? That's the most important question, okay? And part of that question is what that investment that's going to be in my Roth IRA, what's the recovery period on that investment? And what I mean by recovery period is, let's say that I did the conversion of $100,000 and it cost me tax-wise $30,000. I've got $100,000 in my Roth. It's going to make an investment. When is that $100,000 investment going to make $30,000? However long that takes, that's my recovery period. So certain investments you might be able to gauge, it'll be 5 years before that investment makes $30,000. Some people don't know. Some people say, well, shoot, that investment is very low yield. CDs, for example. I remember back in the day, CDs were 0.3%, right? Why would you do a Roth conversion and pay 30% in taxes to let that Roth IRA sit in a CD make 0.3%? Because if you calculate your recovery period, you'll die before you even calculate it, right? Because it's so far in the future, you never see the positive effects of the tax-free growth. So recovery period is key, but it also has to do with what's the investment. Because once you hit that recovery period, once the investment hits what you had to pay in taxes, then it's ching ching, ching ching, ching ching, ching ching. Everything is tax-free and penalty-free from that point on.
This is why you don't really see a lot of financial advisors talking about this stuff, is because they're used to talking about stocks, bonds, mutual funds, CDs.
Right.
And it doesn't make sense, in all honesty. They're trying to make you money. So.
Well, and usually the conversation is when your stock goes and hits the bottom floor, that's when you're converting, which is smart. Yep. And we can also do that with our alternative investments too. I'll piggyback on that. If your investment is, maybe you have a current investment inside of your traditional IRA that's not performing. Okay, this is a good opportunity to consider a Roth IRA. Mm-hmm. Maybe you did a note. Maybe you did a private money loan to an investor out of your traditional IRA. They haven't paid. You haven't heard from them. They stopped making payments. The principal balance of your note is not really worth the principal balance of the note because now it's a non-performing note. So I've seen some investors actually take that opportunity to say, well, let me revalue this note. I'll get a third-party appraiser, and we're kind of skipping ahead. I'm going to talk about this in a sec. But let me get a third-party appraiser to appraise my $100,000 note for $70,000 because I don't know if this guy's going to pay. Okay, they get a valuation. We do the conversion of the asset at $70,000, and then hopefully you get that borrower to pay back again. But you've got an asset that you converted at $70,000 when really it's worth 100. Okay, there's some different scenarios there. You can also do it with real estate. Mineral rights and oil and gas also have an opportunity to do that, what we call converted at discount. If you want to look back, I did a webinar with Chris Allen with Eckert Enterprises. Talked about the value of doing a mineral rights investment that can be valued for less than what the principal balance of the investment is. And in a sense, you can convert it at a discount. So a lot of investors are investing into these investment opportunities with the sole purpose of converting their traditional IRA investment at a lower value than what they invested in.
And just to be a nerd really fast, these are called in-kind conversions. And we have a couple of people who are asking about, can I do X, can I do Y? And they're all talking about the same thing, in-kind conversion. So I have one person asked about precious metals. Okay. Yes, you can convert those.
You convert any asset. We'll get to that in a second. So last considerations, do you want to leave the payment of taxes to your beneficiaries? Remember, if you die and you've got a large traditional IRA, the taxes are going to be paid by your beneficiaries. Okay? If you pay the taxes before you pass on the wealth, well, then the beneficiaries have an inherited Roth IRA, and inherited Roth IRAs have no taxation to them. So again, it's all about legacy there. But here's the biggest thing, guys. I always think, what is the investment? When people ask me, they go, Nate, do you think I should convert this year? And I go, what's the investment? That's my first question always. It's not how much, what's your tax bracket? Well, who's your beneficiaries? It's what's the investment, right? The investment is oftentimes the thing that trumps everything else, because I've even seen investors convert at the highest tax bracket with no kids, no beneficiaries. They did it because the sole purpose of the investment was so good. They wanted to pay the taxes on the egg or on the seed before it became a money tree. So let's look at one specifically where I had a real estate investor do this and took his retirement plan from forever taxed, aka traditional IRA, to never taxed. Now this is Jim. Jim's a real estate investor. Jim had an old 401k that he rolled into a traditional IRA. And remember, 401ks are normally all pre-tax dollars. When you leave a company and you've got a large 401k and it's all pre-tax, by default, that rolls into a traditional pre-tax IRA. So Jim started with a traditional self-directed IRA. Jim was a real estate investor, a pretty good real estate investor, and Jim had done some flips in this certain area. He actually did 4 flips personally, nothing in his IRA. Okay, he hadn't even set up the IRA when he did his 3rd flip, but by the time he did his 4th flip, he heard that he can use his old 401k to self-direct through our company-directed IRA. So he had done 4 flips in this neighborhood, and that's key to the story because Jim was already becoming known in the neighborhood as somebody that was a real estate investor, but he was also very familiar on what he could buy properties for, what the construction costs were going to be, and ultimately what he can sell property for. So he had already done the 4th flip. He just finished his 4th flip. And he had, at the same time, he had a self-directed traditional IRA with his old 401k in it. And the story is that when he's putting up the sign that he sold his 4th flip, The neighbor across the street comes to him and says, hey, I noticed your signs across the neighborhood. I assume you're a real estate investor? And he said, yeah. He said, well, I've got an issue. Maybe you can help me since you're a real estate investor. I was selling my house. I'm moving to North Dakota. I'm working in the oil fields. My family is already up there. We're supposed to be closing on our house in North Dakota, but we can't close on that until we close on this. And our buyer just fell out of escrow. They couldn't qualify for the loan. Motivated seller, motivated seller. So Jim knew right from that conversation that he could probably get a pretty good deal on this property because this person needed to be out of this house and they needed to close in 2 weeks. Okay. Now, what he decided to do is he wanted to use his retirement funds that were sitting there because the purchase price of this property was enough to be funded from his self-directed traditional IRA. But here's the thing. He immediately started thinking, well, if I buy this property in my traditional IRA and my traditional IRA fixes it up and flips it, all the profit is going to be taxable to me. I just don't see it until I take the distribution. And I'm walking into profit because I'm buying this below market value because he negotiated a price that was below what the retail market asked for. And it was below what the initial buyer was buying it as because, again, we have a motivated seller. So the first thing Jim did, he said, convert my traditional IRA to Roth. I've got a good deal in front of me. Okay. So he didn't know quite how good of a deal. He kind of knew, but it was even better than he thought. But the point is that he was walking into a deal. He was getting a property under market value with a motivated seller. So he did a conversion, and coincidentally, this happened in January. Okay. Now, why is it good to do a conversion in January? Well, remember, our conversions, we don't pay taxes on the day we convert it. We pay taxes the year we convert it. So he did this conversion on January 5th, 2019, which means he didn't have to even worry about paying the taxes on the conversion until April 15th, 2020. He didn't even get the 1099 until end of January 2020. So it gave him 16 months to prepare to pay the taxes on the $200,000 conversion. So he converts $200,000 from his traditional IRA to his Roth IRA. And let's just make an assumption that Jim's in the 32% tax bracket. So this is going to cost him out of pocket to pay the taxes $64,000. Okay, keep that in mind. Okay, so he converted this to a Roth IRA. He made an offer in the name of the Roth IRA from the seller. Bought the property for $170,000 in the Roth IRA, okay? Rehabbed the property for about $20,000. All the funds came out of the Roth IRA, went directly to the contractor. And then the Roth IRA sold the property 7 months later for $289,000, giving the Roth IRA that made the investment $99,000 completely tax-free and penalty-free. His cash-on-cash return on this deal was 52%. The taxes he paid was 32%. His recovery period was 6 months. Okay? If you have the ability to walk into an investment like that, by all means convert. It didn't matter what his tax bracket was. He didn't care. He just knew he had the money in his back pocket to pay the taxes, and he knew the investment was that good that it made sense to pay the taxes before doing the investment. And then long story short, he did 3 more investments, 3 more flips, in fact, over the next 2 years, bringing his Roth IRA, I shorted that a little bit, Roth IRA to $650,000. Do you think he's glad he paid taxes on $200,000 now that he's got $650,000 tax-free, and he'll never pay taxes or penalties on any of that money again? He's over 59 and a half. His son will get that tax-free once it's done growing. So that's an opportunity that obviously he kind of foresaw that coming through. Now here's another story, and this is the one that I love, is gosh dang it, I should have converted and I didn't. Okay, this is an investor, a friend of mine. He bought a property out in the Woodlands in Texas. I don't know if you guys are familiar with Texas. The Woodlands was a pretty hot area, but this was outside of the Woodlands. And he did this through an IRA LLC. It doesn't matter. The entity doesn't matter. But he bought this with a traditional IRA or an LLC owned by his traditional IRA. Okay, now he found a 4-unit property that he bought in his IRA LLC owned by his traditional IRA for $335,000. Okay, added only $25,000 in upgrades, but here's the kicker. this property was pretty good. It was in a great area, and he was getting a lot of rents on this property, okay? North of $4,700 a month from the 4 renters back to his traditional IRA. Now, there was no interest payments because there was no note on this. There were some property tax payments and some common repairs, but $4,700 was about what the traditional IRA was netting every single month. So this is a 15%, almost 16% annual return on its investment just on the rents alone. We're not even counting appreciation here. And this is when it started. So rents went up over the next couple of years to $6,500 a month. Because do rents ever go down? No, they always go up. So he started to analyze, wow, I mean, I can keep this property rented. Rents are going up. Now my rent, just my return on investment on the rents alone is 21.6%, 7%, and the property went up to $455,000. So then he comes back to me. Actually, it was a conversation. Him and his wife were sitting in my office, okay? We started talking. He was telling me the story on the investment, and actually he was really proud about the investment. And me being the nerdy IRA guy, I just thought, how come you didn't convert? You know, just kind of blurted out of my mouth. I said, how come you didn't convert? And, yeah. And he said, well, my CPA said I made too much money to convert. And I saw his wife stare a hole through the back of his head. Like, it was almost like you could tell she told him to convert, and he listened to the CPA who gave him the wrong advice, so he didn't convert because he thought he made too much money. It has nothing to do with how much money you make because there's no income limit on conversions. So anyway, before he died, I mean, his wife looked like she was about to kill him. He said to me, well, is it too late to convert? And I said, well, no, it's not too late to convert. I said, well, what's your plan with this property? He goes, well, I wanted to give it to my daughter. Like, this was going to go to my daughter. You know, we're fine on money. We don't really need the money. This is just like for her to pass it on to her. And I say, well, do you want her to pay the taxes? He said, no. I said, well, then you might want to consider a conversion. So here's how it works when you've already got an asset in there. Okay, it's a little bit different than cash. Okay, when we've got an asset in our IRA, for us as the custodian directed IRA to do a conversion, we have to first figure out what's the value of the asset. Okay, you don't have to convert the entire asset, but we need to figure out what the value of it is. So this was near $500,000. They didn't really want to pony up the taxes to pay on $500,000 of additional income in 1 year. So basically, here's what they decided to do. They said, well, we can probably spread this taxation out over 4 or 5 years. So we'll get directed IRA and appraisal each year, and we'll just convert a little bit. And all that's really happening is the property, or the LLC in this case, is going from 100% owned by a traditional IRA to, let's say, 75% owned by a traditional IRA, 25% owned by a Roth. You convert another 25% the next year, the LLC is now 50% owned by a traditional IRA, 50% owned by a Roth. If it was just the house, same thing. Title on the property starts 100% owned by a traditional IRA. The next year, it's 75% owned by a traditional IRA. Same house, just 2 different owners at that point. Okay. This is also when you want the worst appraiser you know. Okay. I'm not telling you guys that to commit tax fraud or anything like that, but this is just, you need a third-party valuation to give us a base value of what the value of the investment is. You don't need highest and best value. You don't need the most aggressive value, but we need a real value of that property. We can't take the tax assess, we can't take the BPO. We can't take anything like that. We have to take a hard, concrete third-party appraiser. But we want, right, the worst appraiser we know for this.
And if you're a real estate investor, it's the one you typically avoid. So you want to go find that one now.
It's the one that pisses you off all the time because they never get the value. That's when you want to pick up the phone and call this person. So, but again, we need the third-party appraiser. That's going to give us the base value. And then you decide how much you want to convert based on that. Okay, it's $100,000. I want to convert 25% of that. We send you a 1099 for $25,000. So again, you can do that. And long story short, they've started to convert this. They've got it pretty much all converted. By the time it's all said and done, this property will be entirely 100% owned by a traditional IRA. They won't have to face the issue with RMDs. And when they pass away, their daughter will get this through an inherited Roth IRA. Taxes paid, renter still in there, cash flowing to her. She'll never have to pay taxes for another 10 years on that property. So Any other questions before we?
Yeah. So I have this person that says, what if I've invested my Roth IRA in real estate and the market goes down? I lose my money in my Roth. They're asking about if they'll be punished by paying taxes for the losses. But you're in an IRA. You're not going to be paying taxes ever.
No, you don't. Yeah. Again, if you already paid your taxes on the Roth, assumingly, so the investment goes down, the investment just goes down. It's not like you're going to have to pony up and pay additional taxes on that investment. But I will say, I'll just piggyback back on this. This is what a lot of stock traders do, right? I had one investor have 35 traditional IRAs or Roth IRAs. The reason he did that is he owned a single stock. I mean, this guy was a multimillionaire. You don't need 35 accounts. But the reason he did that is because he wanted to analyze each retirement plan or each IRA with an individual stock. And if a stock plummeted, he would just convert that stock. Okay. So you can look at that, whether it's stock, real estate, precious metals, oil and gas. If the investment goes down and it's owned by a traditional IRA, great time to think, should I convert? Okay. But also, we're in the right time to think about whether you want to do a conversion now versus later, right? You want to make that analysis. If you're in low income years or you want to squeeze in some income, or you can squeeze in some income, convert this year. But it has to be done before December 31st in order to count as a conversion for 2025. The biggest mistake I see investors make is they get the conversion deadline confused with also the contribution deadline. And they come to us in March and April and they say, yeah, I want to do I made my contribution. I also want to do a conversion for 2025. You've already missed the boat. You're 4 months past the boat. So if you're also looking to do the backdoor Roth and do it all in the same year, you got to do it before December 31st. You can't make the contribution in April. The contribution will go in for 2025, but the conversion is going to go in for 2026. So again, that might not mess you up, but if you want to squeeze it in the same year, make sure you do all of that before December 31st of this year.
And I always like to remind people, December's our busiest time of year. So if you wait till December 31st, you're playing Russian roulette. All right. I think the best time I would say December 15th
before the holidays.
Yeah, you want to get this conversion done and over with, and that's just a good rule of thumb to make sure that you're not playing anything close to the line.
So let's recap, and then I'll see if Michelle has any other questions too. So remember, guys, there's no income limits on doing a Roth conversion. There are no income limits to convert, and no limit on how much you can convert through the year. Once you've had a Roth IRA seasoned for more than 5 tax years and are over the age of 59 and a half, everything is tax-free and penalty-free for the rest of your life. Keep in mind, there is a separate 5-year clock on conversions. It's really just to avoid people from converting and taking the money out penalty-free. So usually the 5-year clock only has to do, especially if you already have a Roth IRA for 5 years, the 5-year clock on your conversions is really just about whether or not you're under 59 and a half, whether you'll be penalized by taking that converted amount out. But again, if we're wealth building, we're just converting to pay the taxes, and then we're investing the dollars to grow it, and then we take distributions after 59 and a half. That's where the math makes the most sense. Assets can be converted as well. We do need a third-party appraisal or third-party valuation, depending on the type of valuation. But again, if you're converting an asset, same deadline, you want to get it in before December 31st. December is our busiest time of the year. Try to get it in before early December. So just give us a call, talk to a specialist here. And then conversions can add decades of generational wealth too. So if it's not for you, maybe think about your kids or your grandkids and think about the type of legacy that you want to pass on to them through an inherited Roth IRA versus an inherited traditional IRA. Michelle, do we have any other questions that we missed? Any good ones?
No, I think you covered pretty much all of it. Really good information. There's one question that just came in on the chat. It said, how old can the appraisal be for Roth conversions?
Oh, good question. So it depends. I mean, it's more of a custodial requirement. We like the appraisal to be within 60 days of the conversion. Depending on what type of property it is or where it's at, we can be a little bit flexible. It really has to do with like how much is the market moving. I'll give you an example. In a hot market, we're probably going to be pretty strict that the appraised value is within 60 days of the conversion. But I had an appraisal on a property that was in like South Dakota, and it was like 3 houses within like 20 square miles. It's like, okay, the property values aren't fluctuating that much. We're not going to ask for another appraisal because the appraisal was 90 days old. So general rule of thumb, we as the custodian want it within 60 days of the conversion. You can't get a valuation and come to us and say, hey, I've got this appraisal from 6 years ago. Can we do a conversion on that date? It's got to be reasonable, because remember, we're just going to have to answer to the IRS depending on, like, you know, what value did you use and what was the date of that valuation. We want it to be within 60 days in most cases.
Yeah, and I think just one more. Quite a few people have asked about inherited IRAs. Can you turn those into Roth IRAs?
Oh, good question. So no, you can't. So once you pass away, whatever it is, that's what your heirs get. If you leave a inherited traditional IRA to your heirs, they cannot convert it. The only person that can maybe convert it is if you leave it to the spouse and they take it as their own IRA.
Yes.
But now we're not even talking about inherited IRAs. But general rule of thumb, inherited traditional IRAs cannot be converted to Roth. The account owner has to convert before death.
Which just emphasizes the point. If you want to leave, if this account is to be left to your heirs, do you want to convert it now?
Yeah.
Or do you want to have them pay for the taxes later?
Right. And just chunk it a little bit, guys.
Yeah.
If you're really looking at leaving a legacy, you don't need a large Roth IRA to leave them, but you need a Roth IRA to leave them. I had a client divvy up his entire traditional IRA. It was like $350,000, and he converted the entire thing, but made 10 Roth IRAs with $35,000 in it, so that 10 of his heirs could have
They just got their own.
inherited Roth IRAs. It doesn't matter how big, but leave them a inherited Roth IRA, and that's a bucket that they can invest for another 10 years completely tax-free. So
Yeah.
great questions. So, okay.
Yeah, if you guys have any questions, the QR code's on there. You guys can scan and book some calls. I see people are asking for more questions, but I think that about wraps it up.
Okay. Well, great, guys. It was great chatting with you guys. Great questions. Hope this was useful to you guys. If you have any email, if you want to email me as well, you can email me at nate.hare@directedira.com. I usually have my email address up there. But if you have any questions, nate.hare@directedira.com, or you can scan that QR code, book a call with Daniel, or just go to our website, go to schedule a call. You can schedule a call with any of our IRA account executives. So thanks, guys. Have a good rest of your Tuesday.